Hello, today I want to talk about options and option strategies. Again, if you want to see previous videos on these topics, you can check out these links right here. Now, today I want to specifically talk about covered calls, using covered calls to generate income, especially during retirement. Now, covered calls are pretty straightforward. You're long an underlying asset, whether that's a stock or an index. From a retiree perspective, let's think about it as an index. And then you're going to write a call on that same underlying security, right? It's going to generate an income through the premium. And the trade off is you're going to cap your upside for market up moves because you're selling the call. Now, why might you want to do this? You have likely several sources of kind of guaranteed income, whether that's Social Security or some annuity you've entered into or a pension or whatever that might be. But you also likely probably have an investment portfolio. Now, that investment portfolio likely is giving you dividends, but maybe that's not enough. And maybe you don't really want to sell that underlying portfolio for a number of reasons. Maybe you just want to keep that notional value there because you want to be able to gift that to a charity or an heir, or maybe you're saving it for me. I don't know. Also, when you sell these things, you are generating taxable events, right? And maybe you don't want that either, right? So how might this work? Well, if we go back and look at some prices, you go back about a month ago, you're able to buy it at the money call for $101. And that would generate a premium of about 2.92% compounded annually. That would give you 41.25% on your portfolio. Looking at today's prices, see that at the money call is worth about $74.90. That gives you about a 2% monthly premium, which is then compounded to give you an annualized number of 27%, which is still pretty attractive. Now, it should be obvious when this would be a successful strategy and when it wouldn't versus a buy and hold strategy. So if the market goes up by more than that premium, then you're going to be worse off. As long as it goes up by less than that premium or it goes down, then you're going to be better off with this call strategy. So think about the times when it is going against you, right? Where it's going up by more than that premium. There's going to be some problems there. You're going to need to close out that position. So you're going to have to buy back that option at likely a higher price, or you're actually going to have to sell some of your index and then deliver that to the original buyer of the option. You have these options. Now, given the nature of dividends and the fact that you're selling the call, you might owe that dividend to the buyer of the call. All of these things can create taxable events that you should be aware of. Also, if you look at the payoff profile of this covered call, it is identical to just shorting a put, right? So here's shorting a put, and we can see here's the payoff profile for the covered call. They're the same, but generally people think of shorting kind of with nothing else there, with no underlying asset, as being a riskier strategy, but the payoff profile is actually the same. Well, so how does this strategy actually work over the long run? And you should be aware that there are actually instruments out there that you can buy, so you don't have to do all this work yourself. So the Cboe actually has an index for doing this. We can see here that there are periods when it does better than buy and hold. There are periods when the buy and hold does longer. And as you would expect, when the market's kind of down or flat, this strategy works better than buy and hold. And when the market's going up, buy and hold works better. You should also be aware that the risk profiles of these two strategies are dramatically different. So this buy and hold strategy maybe doesn't do quite as well over the long run, considering that the market in general goes up. But from a risk perspective, the beta is much lower and the Sharpe ratio is much higher. Also, you can see the annualized volatility here much lower. So from that perspective, it's a very attractive strategy. Is it right for you? I don't know. Whatever you decide, happy trading out there. Thanks so much for listening.